Hello, everyone, and thank you for joining us at the Lytham Partners 2022 Fall Investor Conference. My name is Joe Diaz. I'm a managing partner at Lytham Partners. Today, we welcome CVG, which trades on the NASDAQ under the ticker CVGI. I'll be talking with CVG's President and Chief Executive Officer, Harold Beavis. We will review the company's strategic plan, its operating businesses, the economic and geopolitical events that have impacted the company, and what makes CVG a leader in its markets. Before we begin, I'd like to thank all of you in the audience for devoting some of your time today to hear the CVG story. As a reminder, Mr. Beavis will be available for one-on-one meetings later this week. If you have not already signed up, please visit the Lytham Partners website at www.lythampartners.com/virtual and click on the one-on-one meeting request button. With that said, let me introduce Harold Beavis, President and CEO of CVG. Harold, thanks for joining us today. We really appreciate it.
You're welcome. Thank you. Thank you to everyone listening in as well.
Let's jump in. Harold, please give us an overview of the company. What does CVG do, and what markets does it operate in?
Sure. CVG is around $1 billion in sales, and we make around 7% EBITDA. We have 8,400 employees in 10 countries. We are a manufacturer to global vehicle developers, vehicle manufacturers, especially commercial vehicles, which is a focus area for us, as well as having a division which makes robotic substations and subassemblies for industrial automation. We're a relatively new company. We IPO'd in 2004, and we are becoming a secular growth company, especially with the advent of electrical vehicles and electrification. And we'll talk more about that as we go here, but it's become a secular growth story for us, and we're one of the early pioneers in that industry.
Fantastic. Can you discuss your background and how you came to CVG as the CEO?
Sure. I've been here 8 years. I transitioned from the boardroom to the CEO job 2.5 years ago. Been a CEO since 1998. So a career manufacturing CEO. And I was very intrigued about leading the company into its next phase, which internally we call it transformational growth. And we're very much growth oriented and entering tangential markets where we have a right to win, a right to compete, a right to stay. And it's been more successful than we thought. And so we've attracted a team oriented around those objectives, and we've been announcing the amount of wins that we've had over the last couple of years, and we continue to win new business this year as well.
Great. So let's talk about that. Can you discuss who your customers are and why do they come to CVG?
Yes, our customers, some of them we're not allowed to say their names, most of them due to NDA. As most tier 1 suppliers, but a few of our connections have made it out into the press. And in the past, in our 10K, we've listed some of our customers, and they are Volvo, Daimler, Caterpillar, John Deere, Navistar, Rivian, Nikola, XOS, Volkswagen. So top vehicle makers globally. And we participate on their platforms as they produce in volume with current model years. And then we participate in the aftermarket of those vehicles as they age on the road and are used. And so that's primarily what our business is serving the global vehicle makers and the aftermarket for the fleets that own them.
Well, you've got some big names that you work with there. What is it that CVG does that none of your other competitors can do? I mean, what is your differentiator? Why do these big name customers continue to work with you?
Well, we do have a lot of competition being a global manufacturer, and there are some bigger players in some of our markets, like Active, like Ideant, like Lear. So we do have some bigger competitors. Although we're $1 billion in sales, we're viewed as small and nimble in the markets that we compete in. So nimbleness, quick innovator, and yet having a proper cost structure. These vehicle platforms tend to run 7, 8, 9 years, so you have to be competitive on a total cost standpoint, and we are. And so we rely upon our heritage of being a tier 1 supplier for quality regimens, on-time delivery, and also with being consistent part to part, assembly to assembly, so that the vehicle makers can rely upon us.
Okay, you mentioned the electric vehicle market. It seems to be coming on. Tell us about your entrance into that market. How do you expect to compete there?
Yes, it was a natural extension of our business. We've been a provider of electrical systems to the off-road vehicle market for a long period of time. And the Caterpillar, John Deere names that I mentioned. So we make the electric harnesses for all those off-road vehicles. And as the electric advent happened globally with all these vehicles, we took our knowledge, our decades of knowledge in that business, and we applied it to on-road vehicles. And so it was not a big leap. We needed some special equipment for high voltages, but we understood how to make the harnessing. And so spin forward to today, after 2.5 years, we're making the complete electrical backbone for many, many vehicles globally, and have won platform value, have won several $1 billion of business, annualized out to a few $100 million a year. And we're in ramp up curves on many vehicles right now, on road and off road.
So tell us about how that business will impact the overall CVG performance. How big of a piece of the overall CVG pie is it going to be, in your opinion?
Yeah, so we've set goals for ourselves. Some people that know our company have known that the biggest product that we make for a long period of time is seating, driver seats, passenger seats, that sort of a thing. And already on a pro forma basis, with the amount of wins we've had in electrical systems have become our largest business, and that is our goal. Our goal is for electrical systems to become our biggest business and remain our biggest business. On a reported results basis, our seating business is still our biggest, but in terms of the amount of business we've won and the ramp ups that we're going through in a few years, it'll be surpassed by electrical.
Now, the seating business, is that part of your Class 8 trucks business?
It is. That's our heritage, and some people know us in that way, Joe. They know that we're the big market share leader in high-end suspension seats, expensive seats that go on to these heavy-duty commercial vehicle trucks.
Right. And with regards to overall strategy, what are your priorities here as a CEO in terms of strategies to move the company forward, improving growth, profitability? What are you working on in that regard?
Yeah, so some people have viewed us kind of as a cyclical stock, and have kind of gone with the ebbs and flows of the large tractors, the high ticket item vehicles. And we are on a mission to not be that, to be less cyclical. And in order to make that a reality, we have to diversify our customer roster and diversify our end market participation. This whole electric vehicle pursuit that we've been successful achieving is non-Class 8 primarily. It's primarily passenger vehicles, delivery vans, and work trucks and work vehicles, not Class 8. So it's not a substitution for us. So we still have the Class 8 positions that we've always had, but we're adding this new element to our company of participating in other vehicle types with electrical systems. So as a stock investment, we want to be less cyclical in terms of our end market participation. And then on the profit rate improvement, Joe, the electric systems business is accretive for us, so it's a mix shift, and we've articulated goals to become more profitable. And it's primarily a mix shift. It's not going to take a miracle to make that happen. We just need to grow that part of our business. And it's also our best return on invested capital business. So it'll make us a higher ROIC business as well.
So segueing back to the Class 8 customer base that you have,
Yeah.
You've had some price increases that you've been able to enact. Tell us where that stands. How is that being accepted with your customer base?
Yeah, it's a continuum for sure with inflation, and inflation is certainly not abated. And some can argue in Europe that higher inflation is on the way with the energy and food crisis that the Russian war is creating. And so what that does to us is we're a contractual business, and our business is governed by contracts and a lot of terms and conditions. And we enter a period of time with a fixed price. And when inflation's happening during the subsequent time period, pricing needs to happen in order for us to maintain our profits. So we have had a lot of pricing discussions in the during post-COVID, when things got disruptive, and now we haven't slowed down. So it's a part of the vehicle industries. Ford announced last week that they were having $1 billion of unexpected supply chain costs, and we are too. So we're a supplier to people like that. I can't say their name, but we're suppliers into those industries. And as we are incurring inflation, the amount of inflation is higher than our profit rate, our operating income rate. So we have no choice but to attack those contracts. And it's a tough group if you follow our sector, supplying the global transportation companies and auto companies, and you just can't fatigue about it. You can't be rude about it, but you do have to stand your ground about pricing. And we've been doing that more firmly. I'd say it's muscle now for us. And it's a continuum. We don't see it stopping.
You mentioned the Russian incursion into Ukraine. Clearly, there have been some headwinds to the business in recent quarters with regards to the lockdown in China, Russia, Ukraine, maybe some cyclicality in your business. Can you talk to us about some of those headwinds and where we're heading right now?
Yes. We were impacted this year by the Shanghai COVID shutdown, where we have our most profitable plant, and we have a circle of our main global suppliers, and we were impacted by the Russian invasion of the Ukraine. We have our third largest plant in the Ukraine, and we were temporarily shut down. And then we lost our men that went into service. We've had former employees killed in service. We had to reform a 1,000-employee plant with mainly women, and they're doing a great job, and very thankful for the spirit there. But kind of going through this year, our profits were artificially compressed, and our revenues going through the COVID lockdown and the Russian war. We're getting back to normality in both of those. And the business is re-entering our profit run rate.
Can you update us on your warehouse automation business, which has recently seen a slowdown? What's happening there, and what steps are you taking to invigorate that part of the business?
Yeah, there's two questions there. So what's happening? The big reporters who've been clear about this, public filers, are Amazon and FedEx. And they both reported the same thing, which is that e-commerce and online shipping volumes are down year over year. And in retrospect, they believe that they overbuilt their infrastructure, thinking that this inflection that happened, that they've both been clear about, was going to continue, that it was the dawn of a new era, if you will, for the amount of retail that was going to be online. It's turned out to not be true for the time being. And actually online retail has died down as people took their masks off, went back out to stores and whatnot. And they've taken a wait and see approach. So we make automated warehouse subsystems that go to the top 50 retailers, including them, but not only them, but that what they've basically articulated to the market is what's happening. So as a supplier into new fulfillment centers and distribution centers, we've been impacted. It's hard to tell exactly how long this is going to last, but we're guessing about a year. So, this time next year, they'll probably, if you look at the normal growth rates, assuming they get back on a trend line, they'll need capacity for parcel distribution and fulfillment around this time next year. So it's taking a time out right now, Joe.
Right. But you've got the facilities, you've got the capacity. When they're ready to ramp, you can ramp as well.
Yeah, we've had to downsize our team. So the two things we've done in the short term, one is to right size our cost structure. And then secondly, you asked the question of, kind of what are we doing to revamp it? We're expanding our customer rosters there as well, just like we're doing on our vehicle side of the business. We really didn't have that luxury going through the boom that happened in COVID. We're struggling to keep up really with production. Now that there's a giant pause happening, we are going back out with a more system approach there, a more value-added approach on automation systems. We hired a new president from the industry. He started, and he and I both have automation backgrounds, automation in our backgrounds, him entirely. So we intend to expand our product offering and our customer roster.
With regards to the second half of the year, in your most recent quarterly conference call, you mentioned that some of these headwinds have abated to some degree, and your expectation is that the second half of the year should be reasonably stronger. What can you say about that?
Yeah, so two things. One, as you touched on already, we had two profitable areas of our business in the Ukraine, where we service the electrical systems for Europe, and in China, where we service high-end seats for Asia Pacific, two of our more desirable pieces of our business that weren't able to operate. So that's re-entered our run rate now. And then on pricing, we had a couple big contracts that were trapped with out clauses that we were very delayed and had to suffer the financial consequences of inflation in the first half, and we gained relief on them. So for us, Joe, it's going to be incremental improvement. So we've articulated sequential improvement, Q2 to Q3 to Q4, as we work our way through this. And there's nothing to dissuade anyone from that. That's still our outlook, is a sequential improvement. It's not going to be a step change or anything like that, but it will be steady improvement.
Right. With regard to the macro environment, you've mentioned inflation on a number of occasions here, and you've worked with some of your customers to increase pricing on contracts. What is your sense of how they're feeling about the inflation issue and how it impacts their business?
Yeah, our customers are able to increase their end prices. So if you look at the average sales price for vehicles, they're at all-time highs. And so they've been able to pass their inflation through. We have some of the names I mentioned are public reporters, and they're all having record profits as companies and per vehicle. So they're not suffering as much as us. And we use that in our discussions with them, that we're able to see how profitable they are off of our back a little bit here. So we're very forthright about our knowledge, and it's still a battle though to go through that. but we're not going to fatigue. And in terms of the outlook, it hasn't slowed down. There's been a few spot improvement areas like the price of steel, the price of ocean freight, but there's like labor wages are still inflating, and there's a lot of categories of materials that we use are still inflating. So in the old times, if you will, you'd threaten your own suppliers and you'd move your volumes around, but there's not extra capacity. There's more demand than capacity, so you actually have to be careful with your supply chain as you re-engineer it. And there's no getting around the fact that you're going to incur inflation, and then you in turn have to pass it through.
Sure. Given everything you've just said, are you seeing any sort of shift in demand because of all these macro conditions?
We are not. That we're having an outlook similar to everyone of what's the future going to bring here on GDP, global GDP, because we're in a lot of different geographic markets. And what would a GDP recession do to the vehicle industries? And if you look back in time, GDP recessions lead to vehicle recessions because people have less money to spend on high ticket items. So we're kind of buying into a mild recession. It's really unclear, Joe, what it's going to do to the markets, though, because the vehicle markets have been constrained on output, and there's long waiting lists for vehicles, passenger vehicles, commercial vehicles, vehicles of all types. And so the vehicle industry is thinking that it's going to not be a big impact because they're going to be able to get caught up with dealer inventory, spare parts inventory, and that sort of a thing. That's going to have to, we're going to have a wait and see on that, because in the past, recessions have impacted the industry, and I think it will some. I think it'll cool off some. Sitting here today, Joe, we have backlogs. And we have customers who are upset because they can't get more out of us. And we have open positions because there's more jobs than people. So the industry actually could benefit from a little bit of a cool off, in my opinion.
Yeah. What are the supply chain issues that your major customers are seeing right now? How is it impacting their order flow?
Yeah, there's a lot of shutdowns that have happened and are happening. And again, Ford came out last week and was forthright about how many cars were offline due to lack of parts. All the truck makers, all the vehicle makers. Look at Rivian; they've continually lowered their production outlooks on vehicles, and there's a shortage of everything. Chips get talked about a lot. And so do batteries, lithium batteries. But if you look at all the shutdowns that have happened that we've been a part of and affected by, it's been a lot of things that they've been out of. And in fact, we've shut down some of the customers sometimes as well for seats and cab structures and that sort of a thing. So none of us are immune from this. Production is not at all-time highs. It's actually capped because of the lack of parts. And if you follow the chip part of this, a lot of people are opining on it. And it's also geopolitical because a lot of the chips come out of Taiwan. I don't think that one's going to sort out for a few years. But generally speaking, supply chain difficulties are consistent. They're not worse now than they were last year. They're not, but they're not better either.
In terms of the growth of electric vehicle trucks, how do you see that coming to the fore? How will that market develop? How big of a market will it actually be in terms of competing against a traditional combustion engine?
Yep. We're truck people, so that truck is not a truck. There's pickup trucks to Class 8 tractors. There's off-road trucks. In terms of the heavy-duty trucks, the outlook is that there will be very little substitution, that they will be combustion engine due to the power needed. Like a tractor trailer is 80,000 pounds, and you have 80,000 pounds going up the Rocky Mountains. The battery drains, before you get to the top. And so the duty cycle and the weight of the high-end tonnage is viewed as staying as combustion engine or hydrogen fuel cell when the recharging networks are there, or a hybrid. Electric is perfect for duty cycles that are local, like a bus, like a work truck, like a delivery truck, delivery van, Amazon delivery van. And so the substitutions, there's data out in the market that's easy to get on the substitution rates by vehicle type. The highest will be school buses. The lowest will be Class 8 tractors. Each one of them has a different substitution time period. Now, what's driving it is emission standards. And you have countries like Japan, states like California, fleets like Amazon, Walmart. So you have a lot of mandates coming out for zero emission. And so that's driving the industry to develop these types of vehicles. And they'll, in some cases like California, they'll be outlawed combustion engines for certain vehicle types. And it's going to happen. It's really not if, it's when. And we've been very careful with our electric vehicle endeavor as we've entered the industry to be on the vehicles that will substitute at a high rate.
You've got a reasonably large global presence. You've got facilities in different parts of the world. Tell us about that and how you're able to manage all that effectively and on an on-time basis.
Yep. Our customers are global. And so in some respects, it's natural because they're in all these markets and they want their partners to partner with them in all the markets. And so we naturally do that. And it's we use the same tooling. They use the same tooling. We use the same tooling. They have the same basic platforms. We have the same basic platforms. So a lot of it's customer partnering. In terms of time zones and currencies and labor rates and cost structures, that's all unique to the country that you're in. We have a management team that knows how to deal with global business, and we're set up for it. The largest language we speak at our company is Spanish. We have a lot of Spanish employees and factories. And then we have a lot of factories in low-cost Europe, in the Ukraine and Czech Republic, and we're building another low-cost plant. And then in Asia, we're in China, Thailand, India, Australia, and a lot of suppliers in China. One thing we're doing with our supply chain, though, to simplify it really, is we're regionalizing where we make our parts and source our parts so that we're not affected as much by the supply chain disruptions that have happened in the last 2 years.
You've got a new engineering center that's going up in Phoenix, Arizona.
Yeah.
Tell us about that. Why? What will it do? Give us some background on that.
Yes, when we started this little over 2 years ago, it was a from scratch effort. We hired a gentleman from Detroit that understood vehicle electrical systems intimately for on-road. And we got going, responding to RFQs, making prototypes, had to order a bunch of equipment to make high voltage systems, had to figure out a few things that we hadn't had to do before. And we got it together, and then we started to participate at a gradually higher rate. And it became a little bit overwhelming for our main plant in North America, which was taking the lead in Agua Prieta, Mexico, which is on the Arizona border. And so we decided to open our R&D center there for electrical products. And it's a good place to attract engineers. And we also have a big customer there. And you can drive a couple hours south and the customers can do a plant tour of Agua Prieta, which is on the Arizona-Mexico border. So it was a natural place for us given where our main production facility is.
And let's close it up here in a minute or two that we have left. Let's talk about ESG. It looks like you've made a real concerted effort in that regard, and there's a real commitment. Talk to us about that.
We are committed to our company is all about electric vehicles, which are tied into zero emissions. So we've also embraced our own program to lower our electricity usage with the Department of Energy. In terms of environmental impact, that's our big one. That's the E. In terms of S, our social responsibilities. All of our plants and employees are engaged in their local communities. And on governance, as a public company, governance is very important. We have a governance committee of our board, and we're very strict about that. And ESG was just a natural extension of our core values. So we embraced it quickly. And we're a leader in that. We're a leader in our initiatives in ESG.
Well, Harold, thank you. We're going to have to leave it there. We greatly appreciate your time and really the thorough update on what's going on at CVG. Again, anyone out there that has not already signed up for one-on-ones with CVG, please visit the Lytham Partners website at www.lythampartners.com/virtual and click the one-on-one meeting request button. We hope you enjoy the rest of the conference and have a great day.
Thank you.